I'm thinking the Fed is, at least I hope they're smart enough to understand that they can't, and it's very dangerous to continue aggressively hiking rates. Because again, each rate hike takes a certain amount of time to work its way through the economy, right?
Mm-hmm.
So if you hike 3 times in a row, 75 basis points, and then all of a sudden in 6 months, we're in a deep recession.
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets for Bitcoin. According to Soloway, Bitcoin may face a lot of uncertainties in the near term as a result of the ongoing global economic declines, and that we can possibly see Bitcoin price drop to 12K before putting in a bottom. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
Does this time and uncertainty or time of uncertainty and dollar strength really spell weakness for the markets?
Yeah, so I think overall it's a negative, right? Anytime you have this potential geopolitical scenario, especially after Russia invaded Ukraine, it just opens a possibility that it could happen with Taiwan. It definitely puts people on the back burner. Now, the key is this market has been going up and down inversely to the US dollar. And we know that the more instability, the more upside on the dollar, right? More people hide in the US dollar for safety. And so that, again, just right there is a negative for equity markets, for crypto markets, for gold. Nicely enough, we have potentially seen a major reversal in the dollar today. So we might be seeing a short-term top there, which would be positive for risk assets.
Do the interest rate hikes that we've seen as well really contribute to making the US dollar that much more attractive to foreign investors?
I think it does to some extent. Yeah, I do think, Tom, it does because what you're seeing is essentially the Fed is trying to lead this push, and they're talking so aggressively hawkish. Now, I believe it's a lot of talk. I'm curious once we tick into recession, how quickly they back off from this hawkish talk. But I think they're trying to talk a tough game to make sure that inflation kind of stalls out here and does come in. But I do think raising rates sucks money out of the system, right? So just like printing and lowering rates drives money into the system, it makes money free or at least cheap. The opposite is occurring. So it's a supply-demand economics problem where when you take dollars out of the system, inevitably the dollar should strengthen. And especially since we're acting more aggressively than the ECB or the Japanese central bank, it's going to strengthen the dollar against those currencies.
Mm-hmm.
I'd like to... Sorry, I was just going to say something. If I could just show a chart here for you guys, because I actually think that, we just talked about, I just mentioned Japan, and I actually have a chart that dictates that I think we have a short-term high on the US dollar yen chart, and I think it's really helpful to take a look at. So let's take a look at this. Take a look at this channel. So this, again, beautiful trend line from this high going back to 2022, early 2022 here, and look at the yen, what it just did today, and how it's reversing. So these are the things that as a technician, I kind of watch for. And this, by the way, this doesn't mean that the yen is all of a sudden going to be strong and just continue to rally against the dollar. But what it tells me is in the short term, the dollar may be topping out and due for a pullback. So again, if you're looking over the next couple of weeks, I would expect further dollar weakness, and then this chart should come in. The euro chart is an interesting one, and again, it's a little bit on the harder side to figure out in terms of the highs. I'm looking at this relatively fresh, but this would be something that I would pay attention to. You have this angle where you were chopping along this trend line here, and it looks like we're kissing the low end of that after a very big move to the downside. You can see we had small bounces on the euro here, but for the most part, versus the dollar, the dollar's just been dominating the euro. And again, what's interesting here is this down move is coinciding with this potential bounce in the euro against the dollar is potentially coinciding with natural gas prices starting to fall. This is another really interesting thing. We know that Russia shut off that pipeline to Europe. Everyone was panicking over the weekend. And then what you saw is natural gas started to fall even in spite of that news. And one of the things I look at, and we can go to the natural gas chart here, one of the things I follow very closely as a trader is that when you have bullish news and an asset falls, or if you have bearish news and an asset rises, that does get my attention. It's telling you something as inner workings is going against the common kind of thought process. And so look at the fall in natural gas just over the last, let's say, 3 or 4 trading days. That's a big fall. And it tells me that the euro, if this pressure from Russia maybe doesn't turn out to be as crazy, as bad as everyone's talking about, maybe that's the reasoning why we're seeing natural gas fall and could be the culprit for a euro bounce against the dollar.
So in some ways, you're looking for kind of a reversion to the mean of the euro chart.
Yeah, I think so. And again, it's hard to know how much. I don't know longer term. It's very hard to predict the longer term movements, like in 5 years, 3 years from now. But in the very least, you have to look at the euro and say it's due for a technical bounce. I would just pinpoint this level. Let me show my chart. So a couple levels that I would pinpoint as resistance if the euro starts to bounce. This one would be one of them. You can see these pivot lows right through here, and then just above that. So I think you could get a bounce on the euro, but it probably would run into major resistance around 105 to 106 on the euro against the dollar. Part of it is the psychology of the market. So one of the key components of a technical trader is looking at the mental state of investors who are massively investing in a market. And what we saw was kind of this culmination of fear from Friday when that news hit. We saw the stock market really sell off sharply when the pipeline was announced that it was going to be fully shut off. And over the weekend, all of that fear kind of stewed with a 3-day weekend here in the US. So it kind of created this like max pain level where you inevitably get a reversion or reversal off of this kind of level. Then you throw in these trend lines that we showed, whether it's the Japanese versus the yen versus the dollar or the euro versus the dollar here, and you start to think, okay, this could at least be a short-term pivot point on the charts. And I think, again, just looking at the dollar chart, the Dixie, you've had so much major upside in the charts on the dollar that it's due for that kind of relief pullback. It's just been pushed too hard, too fast.
So going back to something that you kind of mentioned earlier, does the bond market believe how hawkish the comments from Jay Powell were from Jackson Hole?
No, for sure they don't. They don't. The bond market, and again, bond market is the biggest market out there, known as the smartest money. And interestingly enough, we've been seeing, and this is something I noted after Jackson Hole, the stock market freaked out, right? Everyone's like, oh my goodness, Jerome Powell's so ridiculously hawkish. And then what do? I go to the facts. I go to the charts, right? So what I did was I said, okay, well, if he's super hawkish, the most he's ever been, shouldn't the 10-year yield be making new highs? And the answer is I went to the chart and I'm like, wait a minute, he made these comments over here and we've gone up a little bit since then, but you're not even back to the June highs of 3.5% on the 10-year. So to me, that tells me that smart money is saying, hey, Jerome Powell, the economy is going to weaken enough over the next few months where you're not going to hike as much as everyone's anticipating. And therefore, the 10-year, at least as of now, is telling us that it has not made a new high. It is calling the bluff of Jerome Powell.
So, Gareth, again, you had mentioned earlier this idea of a weakening economy and actually ticking into recession. And considering that we've seen the definition change, what do you mean when you say actually ticking into recession? Because we've seen this two concurrent quarters of negative GDP, right?
Yeah, for sure. So it's a weird time right now because you're coming off of the COVID lockdowns and stuff like that. And then obviously there was the surge and then kind of the reflex retraction there. So I think it's one of the most hard times to really figure out what is a recession, what isn't. For me, what I'm going to look at is I'm going to look at the jobs numbers. You start to see a significant uptick in unemployment. We did see a tiny uptick in unemployment last Friday, but it was mostly due to people coming back to the workforce. I think that over the next few months, you're going to see that unemployment rise to 4%, a little bit above. And then once we see the GDP numbers remain weak plus that, then it's like, okay, this is a no-brainer official recession that you could call it that at that point. I think in the near term, that's going to be kind of like a breath of a sigh of relief, if you will, where they're on their downward shift. Now, they may still do another 50 at the next meeting, maybe 25, whatever it is, but they're starting to kind of come down the mountaintop, this way at that point. And I think in the near term, that is a positive for risk assets. My thinking of and why I'm net longer term bearish is that I do see us going into a recession, even if they start kind of coming down on the hikes less and less. We're still headed into a full-fledged recession. And again, I think once the market realizes the Fed can't bail us out of this recession, the market's going to freak out. It's going to say, okay, this could be a long drawn out recession, making up for all the lack of recessions that we've seen over the past 10 plus years. And that could be this kind of stagflationary kind of period in the markets. And I think that's the culprit for the next big leg down that takes us down to the pre-COVID low highs from 2020 and even below.
Mm-hmm. So you think we're going below kind of that March 2020 crash that we saw, and that would be in, let's say, S&P and NASDAQ?
Yeah, so I think into year end or early 2023, your downside target on the spiders, for instance, you're looking at that pre-COVID high. So this is kind of my target. You're looking at like 338-ish or so. But I do think before all is said and done, meaning that whether it's 2023 or 2024, this market will go below there and go quite a bit lower. And I would not be surprised if we find ourselves retesting something down in this range quite a bit lower. Like you could be looking and saying, hey, markets are net down from their all-time highs, well over 50% from the highs put in when stimulus was at its max, when the government was sending checks and when money was essentially free. So I think there's a reckoning here that's going to come to the markets. And again, as long as inflation stays above 2%, ask yourself, how does the economy get itself out of recession once it gets in? And what if it gets bad? And that's going to be a real kicker, right? If we get into a bad recession, unemployment starts spiking to 5, 6, 7%, but inflation is still 4%, let's say. What ends up happening then? How do we handle it as an economy? And I think that's going to be all out panic in the markets when that happens.
It seems like the NASDAQ was one of the, let's say, the main beneficiaries from all of this stimulus. So do you think we have a lot further to fall in the NASDAQ than the S&P, relatively?
I do. I think, for instance, Apple, Apple short term may be due for a bounce, but overall, that stock trading at a mid-20s PE ratio. I mean, in the olden days, and we're talking 10 years ago, 15, 20. I mean, if you go back pre-stimulus and pre-quantitative easing, a company like Apple was trading at a 10 valuation. And I do think that if you get in a scenario where money isn't free anymore and the Fed's not printing, we could see a reversion to that mean of valuations, which potentially, if you see Apple go down to sub $100 stock, think about where the NASDAQ 100 is at that point. Gold has actually been an amazing performer this year. Now, if you're trading it in US dollars, it's down a little bit on the year, but then compare it to like an S&P that's down 20% or close to 20, or the NASDAQ that's down more than that, and you really see the standout of it. But if you looked at the gold chart in terms of euros or yen, it is pretty much one of the only things that is net positive for the year. And again, the reason in dollars is the dollar has rallied, 15, 17, 18% this year alone. And then gold actually is only down, I think, about 4% on the year, something like that. So again, think about that. Think about how the dollar being up 15%. In my world, I would say, if someone told me that, I'd be like, oh, well, gold should be down at least 15%. It's up 15, then the dollar's up 15, gold should be down. And the fact that it's only down what it is very, very bullish. And if you get a weakness in the dollar, if we are seeing a Fed pivot here, where let's say in September they go to 50 basis points instead of 75, watch out, because that dollar will start to fall and the gold chart should take off. And let's not forget that the chart itself of gold is still very, very bullish. It is holding its channel. It's had its big move up from 2018 to 2020. Here it's consolidating. It's holding this low. And again, to me, it's saying that at some point, this is going to start to make that next move up and likely break out to the upside. So I think for the most part, metals are the safest place to be. They've been performing well. Silver, you have that aspect of economic, kind of the industrial side, but I still think silver's at a great level. In fact, I got to show you this silver chart because I just love charts like this. Let me bring that up now here. But look at this silver chart. So here's your flag pattern, which is a perfect parallel line with these tops and these bottoms. And then look at this secondary trend line from here to here to here and right through, and look at what price did. So I think you might even have a bottom in silver here, a major bottom in silver. Doesn't necessarily mean it's going to rip to the upside right away, but a tradable bottom on silver with major technical support. So I'm a big fan of gold and silver here, and I continue to be.
How low do you think we could see Bitcoin go? We've talked about that many times on the show. Last night we saw it break below 19,000. So, is this just this this continuation of this risk off environment for Bitcoin?
Yeah. So Bitcoin really, so one of the first things to note here is that Bitcoin for the last 10 days prior to yesterday was basically trading sideways. And that was while the dollar was going up, which is very unusual. But the dollar spiking yesterday in the overnight last night, it was finally kind of the straw that broke the camel's back. And finally, it broke that 19.5 level, which is the 2017 high. So if I zoom out here, you can see that's this previous cycle high back in 2017. So once that happened, there were a bunch of stops that got run and it kind of pushed Bitcoin even lower. Today, we're seeing the dollar pull back, so it's bouncing, but it's a tough scenario for Bitcoin here. And I do think it's going to ultimately go lower. Doesn't mean if the dollar pulls back a little bit more, it won't have a small bounce. But I'm hard pressed to find a scenario where Bitcoin doesn't at least go to 12 to 13,000 before putting in a bottom. And I have a worst case scenario that's well below 10,000 on Bitcoin. So I think it's important for Bitcoin investors to realize that this is the first bear cycle that the Fed is not printing money during, right? And so you have to take that into account when you're doing your cycle. So if previous cycles saw an 80 to 85% correction, you got to think this one would at least do 80 to 85%, which would be 12, 13,000. Amazing to think that it's the first since Bitcoin. You don't realize Bitcoin's been around for such a short period of time, but it's the first time that the Fed has not been printing during its lifespan.
Yeah, that is a crazy thought. So Gareth, something that you and I have talked about before is this emotional regulation as a trader. So how difficult is it to maintain during a bear market like this? And are there any tricks that you have to kind of help regulate that emotion and keep yourself in check?
Yeah, so bear markets notoriously are going to test your emotions because fear is such a pervasive, emotion to have. And so investors, you have to be ready for that. Now, the number one rule in a bear market is don't overinvest, meaning that the bigger the position you have in a bear market, the more emotional tug when it goes against you, right? So again, if you're investing more than you feel comfortable with, you need to be very careful about that because the market will push you to your extremes to the point where you almost throw in the towel or do throw in the towel. So my policy is, start small. You can always add if it goes a little bit lower. If it just goes straight up, then it was a great trade and you say thank you very much, but always err on the side of caution. And then you have to start controlling that emotion. Start paying attention to the psychology of the markets. Like, if you watch Twitter and you see something where everyone is so bullish on it, you need to create a situation in your mind where you start to say, wait a minute, let me step back. Too many people are bullish. Maybe I shouldn't jump in here. And again, look at Bitcoin. Look at the hype on Bitcoin. Look at the hype on oil when it went to 130 when Russia invaded and everyone was calling for $200 a barrel. The same things repeat over and over again in charts and in markets. And if you can just learn to not be influenced emotionally by them, you get put in such a great opportunity position.